Hello, chart watchers, and welcome to this Thursday, December 6th, Market Watchers Live Show with your hosts, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the day off didn't help the market much. We see the continuation of the selling we had back on Tuesday. The Dow Jones Industrial Average currently down 600 points, although it is off of its earlier low, as you can see a little tail there. The S&P 500 down 55, the NASDAQ down 91, the Russell 2000 down 23. So we are seeing the weakness across the board. 10-year Treasury yield continues to fall pretty rapidly. We got the 10-year Treasury yield now down to 2.85%, down another 7 basis points today. This is pointing to the bond market thinking we've got an economic slowdown ahead, and that is not a good sign for equities for a couple of reasons. Number one, because of that, and then also because money actually is moving into the treasuries, which takes money out of the equity markets. Volatility index continues to shoot higher, back up to 24.6. Just a couple of days ago, earlier this week, it was back at 16. Now it is back up into the mid-20s. Never a good sign for the market. The near term just simply tells us we've got an emotional market on our hands. Financials leading to the downside, along with energy. Both of these groups down about 3.3%. Materials down roughly 3% today, and industrials down just a little under 3%. But we are seeing across the board weakness. A couple of key industry groups. I mentioned back on Tuesday that banks and life insurance companies were taking it on the chin in the financial space. Asset managers actually have fallen more than those two. And you can see this move from 190 back on Monday all the way down now below 170 today. That's a 10% move, more than a 10% move in just the last 2 days in asset managers. Not a good sign for the economy. Also, auto parts. Remember with the announcement of the trade war kind of being a ceasefire and being delayed 90 days? Well, auto parts took a big jump that day, and in the 2 days since, you can see that we've moved to new lows. Auto parts having a rough day as well. Well, Erin, the day off didn't stop the selling. Looks like we've got ourselves a rough market still today.
Yep. I thought maybe they'd calm down, right? And everybody could come back and start buying, but not so lucky. It's not going to be a good day so far.
Yeah, and I mean, we look back at the lows that we saw on the Dow Jones back in latter part of October and in November. I mean, we've gone down, we've tested it again, saw the same thing on the S&P 500. I do like the fact that we're at least seeing an intraday tail, but let's see if this buying continues the rest of the day. I mean, if we finish with big gains today, can reverse these huge losses, that would be a very positive short-term sign, but we don't know what's going to happen this afternoon. It's going to be interesting.
Absolutely. Absolutely.
Yep.
Well, I got rain here. That's probably one of the big news items. It's the second day of rain.
Wow. That's it. That is exciting.
Yeah. So, yeah, everybody's very happy here in California. It's woo.
Yeah, you've got 2 days of rain, and the market's got 2 days of a monsoon.
Yeah, apparently.
A little different, but anyhow. Yeah, what do we got going for today, by the way?
Yes, it's going to be a fun day, and we've got a fun rest of the week. What's hot, what's not. Mary Ellen will be in tomorrow to co-host and go over what is hot and what is not. Tom, you got a workshop on Tuesday. I don't know if you've got a title yet. And then we have Greg Morris coming in on Wednesday, and then Bill Shelby's going to join us on Thursday. So lots of good guests coming up, and tomorrow you'll want to tune in for sure. Today, we're going to start with something interesting, not a regular segment. Go take the poll, because we're going to do a segment, a half-hour segment on whether this is a bear market versus a correction. And so we'll each give our case, and we're already taking your votes in the poll, so just keep on doing that. 10 and 10 to 1, Mohawk Industries is going to be our first symbol, MHK. And then we're going to finish off the show with a scooter report. So stick around for that. All right, Tom, let's get it started. Technical news and headlines, and away we go.
All right. Well, you can see on your screen, economic reports out today. We got the November ADP employment report. Normally that comes out on the Wednesday before non-farm payrolls, but because the market was closed yesterday, they pushed it to Thursday. You can see that number actually came in pretty decent, 179,000 versus 175,000 expected. And so that was good. I think the prior month, I'm just recalling, but I think the prior month was revised maybe 2,000 lower. So there's really nothing horrible in that report, but we have seen big differences between what we see on the ADP employment report and what we see in non-farm payrolls. And I'm going to be watching that report closely tomorrow, because the last two bear markets, we have seen non-farm payrolls, the rate of change in non-farm payrolls kind of rolls over about the time a bear market starts. So tomorrow, I think it's going to be really interesting on the non-farm payrolls. Anyhow, initial jobless claims, again, higher than expected. I think this is the third straight week. And this also is making me wonder about this report tomorrow morning. We'll see, but that was not a good report on initial jobless claims this morning. Q3 productivity came in as expected. November PMI services also close to expected. October factory orders came in rough, minus 2.1%, but that's pretty much what the market was looking for. And then finally, at 10 a.m. this morning, November ISM non-manufacturing came in a little better than expected, 60.7 versus 59. Let's take a look at what's going on in the bond market as a result of all of this. Not good. 3.25%. It wasn't that long ago we were sitting there. It seems like a long time ago now, though, with the current 10-year Treasury yield 2.86%. There are a number of lows down here in the 2.81, 2.82% area. I know we had one close at the end of May that went into the 270s. But I would say that this 281 level down to maybe 270, what is that, 272, 273, I would kind of view that similar to the 2582 support level on the S&P 500. If we see this breaking down below, moving to lows that we had not seen since back in January, I think that would be painting a pretty bad picture for our economy. There's really no reason for folks to be jumping into treasuries like this if you think that the economy is truly going to strengthen the way the Fed has been telling us. So I always follow what's going on in the chart. I don't try to ask too many why questions. And what I'm seeing right now is a lot of money rotating over into treasuries. I don't like it. It's amazing. Remember when we got up to 325, how everybody was screaming that the 10-year treasury, the interest rates was what was driving the market lower? And yet now with the 10-year treasury yield all the way down to 2.86%, why isn't the market rallying? I don't buy into that theory. I think you want to see the 10-year treasury yield moving up for a couple of reasons. Number one, because it points to increasing economic activity going forward. And then it's also a sign of money rotation, money rotating out of treasuries and into equities. So I like the fact, and you go back at history, and I've shown this correlation before, there's a pretty strong positive correlation between the direction of the 10-year treasury yield and the direction of the S&P 500. So when you see a 10-year treasury yield doing this, not looking good. And this is coinciding with some pretty rough market action in the equity market as well. All right, let's take a look at some earnings reports. Because we were closed, the market was closed yesterday, we haven't had a chance to take a look at the earnings reports from Tuesday evening, and then, of course, yesterday, and then today. So this is kind of a summary of what we've had the last couple of days. Hewlett-Packard beat, Marvell Technology beat, Ollie's Bargain Outlet beat. That's an interesting stock to take a look at because they not only beat on the bottom line, beat on the top line, raise guidance, and you'd never know it looking at their chart. Synopsys SNPS came in, matched estimates. OKTA, this is one of the leading software companies for a while. They beat, and they had gapped down earlier this morning. Last time I checked, though, the stock had rallied quite a bit, was positive, but we'll look at all these charts in just a second. And then Kroger came out this morning and beat on their bottom line. So let's take a look at some of these earnings reports. First, we'll start with Hewlett-Packard Enterprises, HPE. And let me make sure I got the most recent chart here for you. It is a crazy day so far in HPE. We gapped down, traded down near the price support area that goes back several months, and then rallied back up to near a 3-month high, or 2.5-2-month high, I guess. And now we've pulled back. So this is a pretty wide trading range for the stock. This is a stock that really doesn't trade that, with much volatility compared to a lot of other stocks. But today it is trying to trade within its entire 6-month range, or not too far from it. So HPE, very volatile today, but so far, I think, showing pretty good resilience after moving lower earlier. Next up, Marvell Technology, MRVL. And here you can see gap up, a sell-off, and now we're back up near the high. Overall trend, though, has been down on Marvell. They did beat on the bottom line by a penny, but I think this downtrend continues to look pretty weak. The only thing I would say is maybe on that last low right here, you can see that the PPO was higher. So maybe we'll make a push for that 50-day, get that PPO back up to the center line area. But other than that, I'm not really seeing a whole lot I like right here. All right, Ollie. This is one I mentioned a while back, that this was a stock that was actually one of the better retailers out there. It was better than, it looked to me better than Amazon and some of the others from a relative price performance perspective. The company came out, they beat on their top line, 283.6 million versus 280.6 million. So just a slight beat by about 1%. Beat on the bottom line, 32 cents versus 31. And they raised their fiscal year 18 revenue and earnings per share guidance. And this is what they get in return, a move down of 17%. Now, this could become a pretty good opportunity on the stock. I just don't like the overall market. I'm a little nervous about the market. But after, the essence of an uptrend is higher highs, higher lows, higher highs. And as long as this moves down and holds on to this low, I think it could present a pretty nice opportunity. But with so much selling coming in, I don't want to buy it here. I want to wait and maybe see a false breakdown and a recovery. And then I can get in with maybe a little bit less, a lot less risk. And that's what I want to try to do in a market like this. All right, Kroger, KR. 48 cents versus 43. Actually, I skipped over Synopsys and OKTA, but we'll take a look at those in a second. You can see Kroger pretty volatile as well. The stock, doesn't really trade in a wide range past few months, 26.5 to 32.5 for the most part. And today it's got more than $1, like $1.50 range. So pretty volatile action, pretty good volume. We do remain in a downtrend. I think overall, because this is in a little bit more of a defensive area, if I was going to buy, I think this is the type of stock I would buy, but I would like a lot better down around 26.5. So I'm going to wait and see if this one pulls back at all. They did beat on top line and bottom line, but they just issued inline guidance. All right, let's take a look at that Synopsys chart, SNPS. This one did beat top line, matched bottom line, inline guidance, just not good enough. Not having a horrible day, actually up 15 cents in the face of a lot of selling today, but you can see long tails to both sides. A lot of indecision on the chart. I would be watching it for now. I wouldn't do anything. I wouldn't own it, that's for sure. OKTA, this is the one in that gap lower, went down, hit that 20-day moving average, and has exploded higher. We've seen a number of these software companies come through with earnings or after earnings. I know recently it was Trade Desk, TTD, that came roaring back after its earnings report. We've seen a number of these companies, trading much better technically of late. And even with the market selling off and moving back down near recent lows, a lot of these software stocks are holding up pretty well. So if there's a bright spot, I know this is a very volatile group, but if there's a bright spot, I think some of these leaders in software would be one of those bright spots. All right, what else we got? Last one I wanted to mention was GIII. This is a company I think that Mary Ellen had mentioned last Friday. Stock did come out, missed on the top line, beat on the bottom line, raised their guidance going forward, and the stock looked like, this is what I was talking about earlier with maybe checking out a false breakdown on other stocks, when they pull back, like Ollie, if it were to go back and go below a prior low and then reverse. This is what it would look like. Long tail to the downside. Looked like it was breaking down. Who in the heck would be a buyer down 31 or 32? Market makers. And it looks like, at least in the short term, maybe it's going to hold that price support level. If I was buying stocks, this is something I might consider, but I'm not buying anything right now. I'm going to watch the market, see how we finish today. All right, Erin, I know you have a few upgrades, downgrades. What do we have for today?
I do have a few here. Let's go take a peek. All righty. Yeah, actually, if you looked at the rolls today of upgrades and downgrades, there were just a ton of upgrades. So I'm only going to show you a few, but I'll let you know some of the big names that also have reported. So hold on.
Wonder what does that mean when you're down 600 on the Dow and almost 100 on the NASDAQ and you're getting all these upgrades?
I know. And wait till you see these charts. All right, so we'll go ahead and we're going to start with ANET. Let's see. I've got to get my list here. All right. So ANET was upgraded by B of A. I'm going to move that, make it a little bigger for you. It was upgraded today by B of A from a neutral to a buy. One of the things I wanted to point out on this chart, well, first of all, it hasn't gone down to test this area of support. So despite the upgrade, I have a PMO topping below the zero line for the second time. All of these things look fairly bad. I know some people might point out and say, oh, wow, that looks like a perfect head and shoulders, getting ready to form here. I don't consider it a head and shoulders. It can't be a head and shoulders because it's a reversal pattern. So you need to come, if it's going to be a head and shoulders, you actually need to go up and into it rather than down and into it. Now, if you had a reverse head and shoulders here, yeah, we'd be in business there. So at this point, looking at the formation, I think you could make a case more so for a triple bottom. Maybe we're going to get a fourth one, but I don't see this one making its way back up to test overhead resistance. It's dropped below the 20. I don't care that it was upgraded. I don't want it. All right. We also saw that Spirit Airlines was also upgraded today by Credit Suisse, neutral to an outperform. As you can see on this chart, we had a really beautiful gap up at the end of November, and we continued that rally, but you can see we're starting to top off just a little bit here. I'd be a little leery of this. We're getting a really overbought PMO. We could see that gap at least tested at that resistance or that support level. But honestly, I mean, the expectation would be to see that filled unless we can get at least another gap up. That would tell me that this was more of a breakaway. So we'll have to see, but I don't like that the PMO is where it is. Tilly's was upgraded. Pivotal Research from a hold to a buy. All right, this has been a lot of fun on this chart, huh? Since September. It looks like, though, however, we're down here and testing some interesting support levels. I'll just show you this, and then we'll take it out maybe to a weekly so you can get a better picture. Make that fat. All right. So look, as you can see, I lined this up with these lows over here, and we're now sitting on it. And in fact, if you look in the thumbnail, we hit it, bounced, and now we're trading near the top. So this, I think there's some possibility here, but it's in a group sector I'm not really interested in right now. But I think if you wanted to, keep an eye on this, the PMO is trying to decelerate in very oversold territory. So, all righty. And a couple of other big name upgrades, well, quite a bit that I don't have time to cover. Activision Blizzard, ATVI was upgraded, Discovery, NetEase, Rio Tinto, Southern Copper, Toyota Motor, Avalon Bay, Bristol Myers, Vulcan Materials, and Western Digital. I don't know, Tom. It sounds like they really want us to get back into the market right now. That's a lot of upgrades for today, and that was just today. All right, so
I was just going to say, looking at that Tilly's chart, I mean, and I would not be upgrading it. I'd have some other words for it, but that would not be an upgrade. I mean, I do see that price support from April, May, but outside of that, I don't really see a whole lot going on there.
Oh, no, exactly. I suspect even the weekly chart's going to be pretty ugly. Oh, yeah. See, there's plenty of room. If we don't hold this support, there's plenty of room for it to move back down and test some support levels back here at $8. So sell signal. Everything looks pretty bad here, but I don't know. Pivotal Research Group seems to think that it's a buy now. So, all right, downgrades. Okay, the first one I'm going to cover is Finisar Corp. This one was actually downgraded by two different agencies, Jefferies and MKM Partners, and both of them basically downgraded it to a hold or a neutral. So it's not, the worst downgrade ever. But honestly, looking at the chart, look at that PMO just curving right over in overbought territory. We got a little bit of a gap down today. It seems to me we're ready for a bit of a pullback, and it might be hard for it to, be able to pull itself and manage against the winds that are moving downward in the markets right now. So this one could be a little bit difficult, but apparently, let's see, yes, it is a neutral at this point. Macy's was also downgraded today. This one was downgraded from a neutral to an underweight. not something you want to see. And certainly when I look at the chart, I can see why we got the downgrade. We've got a PMO topping below not only its signal line, but below the zero line. So that's, to me, especially bearish. We are getting ready to test some pretty important support, I guess, here at that short-term level. But you can see we already lost support at this level here at $32. So there's room for it to move lower. I'm not liking it. So other downgrades I'm not going to cover: Bluebird Bio, Facebook, and Toll Brothers were also downgraded today. Here is your summary slide of what we just looked at. All righty, I will have this list in the Market Watchers live recap if you're interested in going back and looking at them. All right, Tom, time for our next segment, and I suspect you're going to make me start.
Yeah, I mean, go ahead. Yeah, we're going to talk a little bit. I mean, this is really the rage right now in the stock market. Is this correction? Is it a bear market? What should you be looking for? Any thoughts, I guess. So we've talked about it quite a bit yesterday. I know you and I and Greg Schnell talked a little bit about, we didn't have much time, but we talked a little bit about, what we thought of the market going forward into 2019. And so maybe this is a little bit of an opportunity to expand on that and
yes,
just kind of give our thoughts on what we see in the market. So yeah, take it away and whatever you got.
All right. So the idea is bear market versus correction is what we're talking about. And so I'm going to just show you some slides. I took the poll and I said bear market. So I feel like it's time to go out on that limb. I mean, a lot of other people that I respect, Arthur Hill, Greg, I believe, is on that limb, and of course my dad. So we'll see if it cracks and breaks, but hopefully not, right? Or hopefully it will, because then we'll end up with a bull market situation. So anyway, I'm going to just go back to a blog article I wrote. I think I kind of went over this during one of our Market Watchers Live shows. Let's see if I can get to blog articles here. Oh, I'm already there. So go ahead to the StockCharts blogs here and go to Decision Point. And on November 20th, just move down here. Lots of good articles, though. On November 20th, I looked at the daily PMO on the longer-term charts. And I wanted to take a peek to see what the daily PMO had looked like in previous bear markets. And so I went ahead and I did a look, and it starts down here. I took a look at 1964 to 1975, and I marked what I thought were similarities before and after bear markets. And then I also did the same for 1998 into 09. And then I did it again for 08 to current. So I want to just show you some of the things that I saw on the daily PMO, and then we're going to just look at the weekly and the monthly PMOs, because that's what I've been looking at. And honestly, with the monthly PMO and the weekly PMO being on sell signals, that pretty much was the deciding factor for me, because that just doesn't happen that often. I mean, we've seen it before, obviously, in a few corrections, but it typically is bear market warning. So let's start. I'm going to go over here and we'll get to the first chart here. All right, so this is 1964 to 1966. And actually, I want to go to the one I thought I had marked this one up. Let's go back to the one I had. Okay, right here. Get the live version, because this one's already marked up. It'll be easier. Okay, so what I was looking for, like I said, was the behavior of the PMO over time. This is the more recent charts. So this is 08 to 18. And one of the things that I found was before the bear markets, you end up looking at what you get is a very extended oversold PMO. You move back up and then you fail and come back down. And I know that sounds like, oh, that must happen all the time. It doesn't. It doesn't. So that was one of the things that I found that happens pretty much all the time, that I noticed before the bear markets. And then what I noticed after that was, well, when do we know when it's over? We get a positive divergence on the PMO. And there it is, rising bottoms, declining bottoms, and boom, out you go. Now with the corrections, let's look at that. Okay, so we started down here, and we make that move in 2010 right down. And what happened to the PMO during that period of time? Well, we were not where we were. We didn't move down that low. We were not even oversold or oversold at this point. Either of these. We had the PMO up high, but we still had to move back down. We did get that false turn, right? But then when we made the next move, we ended up with a positive divergence. So similar, we had the move, right? We're getting ready for this correction here in 2011. So let's go down and see what our PMO is doing. It topped, it came down really low, and then it came back up and it did top. But then the PMO came down and we ended up with another positive divergence and we came out of it. In the case of this previous correction that we saw back in late 2015, 2016, similar idea. So right, we're at the top, we came down and we extended ourselves on this. And that's when, to me, that's the flag. Okay, is this going to be more than a correction, or is this, what's going to happen? And it did turn back down well below the zero line, but you can see it was really just a little try to get up there. And then again, positive divergence at the bottom. And that told me we were moving out, right? We don't have that positive divergence right now. That's what I want to see. We have an opportunity, but that's what I want to see. We don't see it yet, but we didn't extend all the way down below the 2 level. So that's why I feel like I'm going out on a limb a little bit, because we didn't actually extend past that, past -2. All right, so let's go back and look at some of those other charts. And then I will give you your opportunity. Okay, so this is the weekly chart. Now I want to get this straightened out here. Okay. All right, so that's the daily chart from 64 to 75. And I have it marked up over here. Well, we'll mark it up as we go. All right, so what we can see, again, we're trying to figure out when we're getting these giant declines. And I guess it's up to you whether you think it's a correction or a bear market. In this case, I would say that's a bear market. That's a huge loss. Another bear market correction here, and then another bear market here. And so we're going to look at what the PMO is doing right before each of these. And again, extended. This time we extended, but like this time, we didn't actually get below that -2. And we didn't really fail in a big way below that zero line. We had a little bit of a tap there to turn over, but it wasn't what I would look for. So that, I would look at that as more of a correction that we're seeing here. Now, before this particular bear market, what happened? Okay, these are our dailies. Okay, I want to get to the one I marked up. It's just easier, guys. So thank you for your patience. I had all of them up, but I don't know. I get messy with clicking my tabs. Okay, let's back here. 64 to 68. Okay, so what I noticed before this correction, again, to end the correction, we had the positive divergence, and that's when we moved back to the upside. But what happened to give us some warning about this being a bear market? We had to extend way down here. We had to, of course, digest quite a bit of a decline, but that's what you have to do if it's going to be a correction or if it's going to be a bull market or a move back up at this point. That's when you need to start looking at what the PMO is doing. It got very extended. It went well below -2. It came up and it failed. And it came back up, and look at the PMO tops are declining here. There's a lot of bad things looking at this. So what happened is at this point, that's when we would start looking for the bear market. And then to get out of the bear market, you can see we overextend, we get very overbought. And that's when we know that we're probably in good shape at this point. So let's look at another one here. And again, this is my November 20th article. So this is 98 up until 08, 09. And here are the similarities that I found. Okay, when were we in a nice when we knew we were done with this correction, right? When we knew it was because we got very, very, very overbought as we came out of it. And that told me that, okay, we're pretty much okay. We've still got some more upside to go. When the problem came was when we did this again, we popped down below and then we came up, and you can see here, we failed twice to get above the 0 line. And, that was indication that there were some serious problems internally. And while we had to digest some decline, it did give us warning to not have to digest all of this decline. And when it ended not only with a positive divergence, but we see after we started the rally back out, we ended up with a nice overbought reading, which led to more upside. So here's the right before the 08, declining bottoms, pop below the -2, failure below the 0, and there we go. We continue down. We haven't gotten overbought. We get extraordinarily oversold, end up with a positive divergence, and then we pop up here above overbought, and out we go. So that is that one. And I just showed you this one earlier, but same idea, pop below -2, failure, and then decline, come out of it when we get that positive divergence, and a pop above the +2 mark. All right, so those are what the daily charts. It's really easy to look at the weekly and the monthly charts here. So I had just put these together here. So this is the 68. This is the, you save it as one thing and then it shows something else. Okay, weekly chart from 64 to 75. And you can see before all of these, of course, you ended up with weekly PMO sell signals. Granted, it's a weekly chart, so you're going to see that sell signals, periodically. But when you match that up with, an ugly PMO, that's when you start to get concerned. Also, I look for declining tops as a warning. So that's what I was looking. This is the weekly chart. So those were the weekly signals for that period of time. And I'm going to make this a monthly now. All right. Sell signal on the monthly chart. Sell signal on the monthly chart. Sell signal on the monthly chart. It's pretty right on. We had a fake out back here, but typically that's what you're going to see when you get those sell signals. All right, so let's get back here. Going to look at 98 to 08, and this is the weekly chart. So again, you're getting those weekly sell signals coming in here. This is declining tops on the PMO as we're getting those minor, I would call them sell signals, and this of course was just, they didn't tell us much, but once it started to increase its margin between the signal line and itself, that's when we started getting that move well to the downside. So the weekly chart, those sell signals are pretty good, but there are a lot of them. So the monthly chart is where I look for the best sell signals. This is 08. Yes, that's the one I want. We're going to make it a monthly. And there you go. Sell signal. Sell signal. The monthly charts don't get a lot of sell signals, and I'm just going to go skip over to that right now. And that one is in here. And this one you can get to, it is in my Decision Point Live chart list. So the link is right there at the top of my blog page. So here we go, 1946 up to 2018. I've marked all of the sell signals. We don't get that many. I mean, you can count what on, your fingers and toes maybe, how many sell signals in the last, 40 years? 75 years, yes. So when I get those sell signals on the monthly chart, I pay close attention. Now, in this case, of course, we did. It ended up turning into just a correction. But typically, these do lead to very bad things. Now, there's a correction. There's a little bit of a correction. We didn't get much out of it there. but you could see we had a lot of hesitation once it dropped below. So that was sort of a warning there. But when you get these, some of these were just very clear. So the main thing is of course, these don't always work, but what you want to consider is the fact that a lot of times they do work. And we just got a PMO sell signal on the S&P last month, at the end of last month. And so I'd be a little bit concerned. And it's coming alongside, there you go, a negative divergence, declining tops, rising. So I think that's another warning sign as well. So I'm going into the bear market camp. I think, maybe to some it might seem a little bit early, but I'm going on it really mostly based on this monthly chart, because we just don't get that many signals. And, the last 3 times we did, they were fairly accurate. This ended up being a correction, but the times before that, it was a bear market. So, all right. So that's my bear market versus correction. What say you, Tom?
I'm going to stay in the unsure camp at this point.
That's so easy. I wish I'd done that.
I give the benefit of the doubt to the bulls because bear markets come along very infrequently, and corrections feel like bear markets. And so until we get the breakdown in price, and I'll go over that a little bit as we go through some of these charts, I just think that many times these corrections can make you think bear market and call bear market prematurely. And I had trying to think if it was an email or if it was a response on the survey, but someone said, I should be careful about, I guess being a little clearer whether or not it's a bear market or not a bear market, because, folks might get in or out based on some of the things we talk about. And I would simply say that it really depends on the type of trader that you are. I'm a pretty quick and nimble kind of a trader. So if I think if we're in a correction or a bear market, it doesn't really matter. If the market's going down, I want to be out. Mm-hmm. But I think it does matter if you're a long-term investor, and whether you're looking at this as a possible correction or a bear market, I think it makes a big difference. You don't want to start reacting to corrections from a long-term perspective, because then when do you get back in? When correction, but if you never break down and then you start rising, I think you can really start to make a lot of incorrect decisions, because the market will correct from time to time. So I need to see the price breakdowns, and hopefully as I go through some of these charts, maybe it'll become a little bit clearer. But let's start off. I'm going to go from 1989, and I'm just going to break down the charts for, I don't know, maybe 6, 7, 8 year chunks between 1989 and now. And I tried to end the chart like here at the end of 95, where we were clearly in a bull market. I don't think that moving on to the next chart there will have too much of an impact. But what I have here is a weekly price action on the S&P 500. Underneath, I have the volatility index. Below that, I have the XLY, XLP, but those two sectors didn't come into being until later, so that's why you're not seeing anything from 1989 through 1995. And then at the bottom here, I have transports, utilities. These are some of the key intermarket relationships that I like to take a look at. And then the VIX provides me the sentiment that I want to follow. So starting back in 1989, and we had a correction in the latter part of 1989, early 90, and you will see the weekly PPO go negative. One thing that you want to, I think, pay attention to is I do think the weekly PPO is important, because it tells you, as long as it's above zero, there should be no question in your mind that the weekly momentum remains positive. Yes, it could be trending lower, but as long as it's above zero, what it's telling you is your short-term moving average is still above your longer-term moving average. And as long as that relationship exists, you're in an uptrend. When it crosses the center line, that's when it starts to roll over, and it should at least make you think that we could be beginning a downtrend. You can't have a downtrend with a PPO above the center line. It's impossible. So it's just based on sheer numbers, and there's a mathematical certainty. If you start downtrending, this PPO will go into negative territory. But as you're going to see on many of these charts, sometimes you go into negative territory as you simply consolidate. And that doesn't mean that you're in a bear market. Now, back in 1990, you can see pretty pretty bearish action here to the downside in the second half of 1990. We went below these prior lows. I can't remember my own trading back then. I don't remember how I reacted to this particular move. StockCharts wasn't around, so I was probably not paying nearly as much attention to the charts as I do now. But this was kind of one of those things where we went down and we just came right back up, kind of a V bottom. We did have a little bit of a head fake above a double top, and we saw a little bit of that back in September and October on our major indices, where the S&P went to a new high after all the selling back in February, and we'll look at that in just a minute. But here was a little false breakout. We went back down. I'm sure that would have gotten a little testy, but moving back up through the 50-week moving average and moving back into positive territory on the PPO. One thing you will see in a bear market is the PPO doesn't go back positive, or at least I don't believe it did on any of the previous ones. We'll look at that in just a sec. But just looking at it, you can see we hold the 50-week moving average. PPO remains positive. We stay in an uptrend. And then in 94, we had a little bit of a correction. We were up over 480. We dipped below 440. That's a little bit more than 10%. And as a result, we just sideways consolidated here. The PPO had all kinds of mixed signals. But the initial move down with volatility spiking, we never went back down below that prior support level. And so we consolidated. And then once the base period was over, we move out of it, and you can see the bullish action that took place after that. Let's move from 1996 to 2002. Here, again, for the most part, as you move higher highs, higher lows, nice uptrend. One time during this period before the bear market kicked in, only one time back in 1998 did we see the PPO move back below that zero line on a weekly chart. We saw the volatility index spike up into the 40s, which was huge. We did manage to hold on to this prior breakout level, though, and the prior lows. Again, an uptrend is a series of higher highs and higher lows. So as long as you continue to trend higher, I think you're in pretty good shape. Now, if you look at some of the weakness that took place in a couple of these areas, check out middle of 1998, higher prices, lower PPO, negative divergence. We go back down, went a little bit further than the center line, but essentially we reset. We held on to that prior support, came back up through both the moving averages. The 20 never crossed below the 50, and then we started rising again. 1999, higher prices, lower PPO. We go back down to the 50, reset at the center line, and start going up again. Now, what I noticed, first of all, back in the late 90s, early 2000s, the VIX remained elevated. It's one of the few times in history, and maybe the only time in history, that during an extended bull market, the volatility index was high. But if you remember, and if you were trading the market back then, 1999, 1998 was crazy in terms of the volatility. You wake up to AOL saying we're going to split our stock 4 for 1, and all of a sudden AOL goes up 30% that day. I remember some of the stocks, CMGI. Oh my gosh, I don't even want to think back to all those days. But some of the stocks that had no earnings, they had nothing going for them. They were just all over the place. You had companies, PSINet paid $200 million for the naming rights to the stadium in Baltimore, Maryland. They didn't have any profits, but they just were throwing money out. And all these companies had no fundamentals to back up when their technicals broke down. Nobody was buying from a technical perspective. Nobody was buying from a value perspective because they weren't worth anything. So technology really led the bear market. But when you take a look at this bear market, how it began, first of all, notice that the final high, we were moving up. Market looks like it's getting ready to break out. The low on the VIX hit 16 and change and then bounced from there. And during each one of these rallies, every single one of these rallies, when the VIX would pull back, we never went back down below 16. You have to have a certain element or level of fear to have a bear market. Notice also, and this is where I think when the breakdowns come in, you might say, well, I kind of look at where we are now is kind of where we were back in here, where we're, got some other support levels. Maybe it's just sideways consolidation, but we started acting more bearish. Look at the breakdowns below the 20-week, and then look at the failures at the 20-week. Look at the weekly PPO, and then look at the volatility index. These were all things that, in my opinion, were very bearish at the time. look at the XLY XLP ratio from the top here in April to the top in September. S&P was equal, but look at what was going on in consumer stocks. Money was rotating in a very, very big fashion away from consumer discretionary and into consumer staples. Why would you do that in a bull market? Makes no sense whatsoever. So there were subtle signals taking place under the surface, and then we started getting bearish tendencies on the charts. We broke down. And so if we break down price support, what I'm looking at right now in the market is, if when you look back at 2001, on this breakdown here, this is kind of where I think we are now. Look what happened after we got the price breakdown. At this point, I think you can start trading by bear market rules. Here we come back up. We did get through the 20-day, but we failed at that prior price support, which then becomes resistance. Then we go to a lower low. Look at this, lower prices, slightly higher PPO on that reversing candle. We go back to the 50 instead of the 20. And when we go back to the 50, where does the VIX drop to? About 20. We go back down, come back up, double top at the 50 again, start to head lower. And on that double top, where's the VIX? Back down around 17, still elevated. We never got the price breakout. And then we roll over and head lower again. So it wasn't until we set this low back in 2002, and you could already see money rotating back in towards the more aggressive consumer stocks. Although I'll be honest, this bear market was much more about technology than it was anything else. Everything got hit, but technology was definitely the area. I remember Cisco falling $73 down to 11 or something like that. That was a company that did have value, and yet it was just everything was being thrown out on the technology side. All right, let's move on. Let's go on to the 2003 to 2009 chart. Very similar action. We got a nice uptrend in play. We would come back basically to about the 50-week moving average. We'd hold. Notice the PPO. If it did go below center line, it wasn't there long, came right back up. So, yeah, there were some corrections along the way in here, and you could see some spikes in the VIX, maybe up into the upper teens to around 20. But quickly, the VIX went back down, and when the VIX goes back down, the market gets complacent. Bad news doesn't matter. The market just goes higher anyway, until we got to 2007. And when we topped here, notice, first of all, we had the negative divergence. Also notice that the VIX, after spiking, where did we pull back to? On that final high right here, we actually broke out, put in a new high in October 2007. The VIX pulled back to about 16. So the fear was still there, even though we were breaking out. Now, when you look back at these prior lows, notice how we had two lows back at this point around 1370, and then we come back down to test it. Well, once we broke down below that prior support area, went back up, couldn't get through the 50-week moving average. Notice the weekly PPO is negative, never goes positive, and then the selling begins. So once you get these breakdowns, to me, the game changes. You get a rush back to the upside, and you get the VIX back down to around 16, 17. That is a very classic high reward to risk short entry point. I don't think we're there yet. That's why, for me, I'm cautious, but I'm not bearish. Big difference. When we break down, if we break down below that S&P 500 support area around 2582, I think we'll be kind of in this stage of what could be a bear market. Now, this bear market was brutal. It's one of the worst on record, so I wouldn't expect anything like this. But we'll probably get a bounce, and I'm sure we'll have a couple more legs lower, and we'd be looking at probably for the next year, 12, 15 months of pain. And in that market, in my opinion, bounces should be shorted. I don't think we're there yet. We need to break the prior support. So when we look at where we are now in the market, this is that prior support. Now, there was a lot of weakness back in 2016, and you will see on an intraday basis, we actually did barely pierce that 2014 low, but that's when the VIX shot up. Notice in this period, the VIX actually went back down into the 10-12 area. We did shoot back up with these prior lows, but again, we never had that breakdown on a closing basis. So if the fear was driving you into thinking that this was a bear market, it would have been a really big mistake if you're a long-term investor and you got out here. because now all of a sudden you shoot back up. Where are you going to get back in? Are you going to get back in when you get in your price support after we've already moved back up 300 points? I don't think so. I think you're going to be probably sitting on the sidelines. Are you going to all of a sudden start to turn into a trader? Probably wouldn't be the best thing to do if you're more of a long-term investor. So that's what I'm looking at here. Yes, we're below. You can see the weekly PPOs turn negative. Definitely that's bearish. I have nothing bullish to say about a crossover like that, a bearish crossover, the center line on the weekly PPO. That, to me, is indicative of either a correction or a bear market. It doesn't mean you have a bear market. Here, you can see we had it. It never turned into a bear market. It was simply a brutal correction before we ended up going higher. So we've got the fear in place. We've got price support still holding. We've got bearish action at these moving averages. That does bother me, but we haven't seen that breakdown yet. And by the way, the S&P is 2662, so we're quite a bit off the earlier low. I just think there's too many mixed signals in the market right now. There are definitely signals that make me worry. There are other signals, like I'm going to show you one last thing. If we go into my blogs, articles, and I think it was a few days ago, a bear market signal that hasn't turned bearish yet. And if you go down to the current outlook, I think it was, I had an S&P 30-year chart, and I did an employment numbers down at the bottom. So let's look at the live version here. And what we saw before each of the last two bear markets was a slowdown in the employment numbers. The rate of change began to slow, and you can see that right here. Here is the rate of change. Well, here's the non-farm payrolls number, and here was the rate of change dropping and eventually breaking down below that kind of zero line. That was right near the top of the bear market, right before the bear market. Same thing. We had a nice move higher going straight up in the employment numbers. And when that started to slow and roll over, that was the signal that we were about to enter in a bear market. Look at this number. Look at these employment numbers. How can you see jobs expanding and the rate of change continuing to move higher and say we're going into a bear market? It doesn't make any sense. So, yeah, I've seen a lot of mixed signals here. And so on the poll, I did answer it, and I answered it not sure. I think we're in a correction. I believe I stick to bull market rules until the bear market beats me over the head and we lose price support. We haven't done that yet. I think, too, if you look at some of these major reaction lows that we've seen on the S&P 500, that also comes in around this 2550, 2580 area. I think if we go below that, I'm going to be saying that we're in a bear market until the market proves me wrong. But right now, I'm going to stick with correction, although I did answer the poll not sure because I just see so many conflicting signals right now.
Yes. Well, I'm stealing the screen. This, again, my monthly chart, I just counted it up. This is a 75-year chart. I've only gotten 18 sell signals on it in 75 years. So, I have to listen to that. And I know I confused a little people when we looked at the weekly and daily PMOs, but start here and start looking at the sell signals on the weekly chart, start looking at the daily sell signals. I'm sorry, 18 times in 75 years. I have to be, I have to start working with bear market rules, selling into strength. If I leave money on the table because of it, I'm okay with that. I mean, obviously, I'm not as advanced in years, so some people really can't absorb that. But for me, I don't mind leaving some money on the table as it starts to rally. There's still, at that point, there's always something that might be interesting. But anyway, that's my final 2 cents.
Well, I would say, though, even kind of as a counter argument to that, there weren't 18 bear markets.
That's true. That's true. But each one of those was very painful decline. So.
Well, we're already in a painful decline, though. The question at this point, are you buying? We were 2,900 on the S&P. We're back down earlier today. We were down near 2,600. So if you're going to get out before the breakdown occurs, I'm just saying if it does turn out to be a correction, that's going to be a painful move out of the market if you're a long-term buy and holder, and this turns out to be nothing more than a correction. That's, all I was thinking.
I totally get that, but since 99, this is only the fourth. So to me, it's like, it's that, I'm not sure. Of course, none of us know for sure, but to me, I'd rather start divesting on this sell signal and watch the monthly PMO. If it starts to decelerate, right now it's accelerating. So yeah, once I start seeing some signs that this might not be as dastardly as it appears. But yes, I mean, the long-term investors, of course, I have a couple of very long-term holdings, and I am holding them right now, my very long-term ones, but waiting to see if this, if we get more of a decline, because right now they're doing okay. They're not like losing a ton of money, but all of the intermediate to short terms I've been slowly just taking out. So.
Yeah. I know for me, again, and I if this isn't about the PMO as far as I'm concerned, it's about the PPO, the MACD, it's any of these momentum oscillators, especially monthly. They are so slow to provide signals. As you said, there were only 18 of them since, in the last 75 years. My problem is if this starts to turn back up, I mean, technically you don't get back in until you get that cross to the upside. I mean,
no,
saying that, if it starts to improve, but I mean, technically this market could be back up at 2,900 on the S&P before you get that signal to get back in on a monthly.
Right. Well, with a monthly, because it is lagging, and honestly on the weeklies and even a daily, if you're in a decline, and as soon as that PMO starts to decelerate and turn up, that's where I usually look for my buys, my purchases. So I will just watch it, and that's your notice. I mean, I don't wait for a buy signal on the monthly chart. I mean, I don't, but make sure your confirmations make sense too. Right now it's just, I don't know. It's good. We can have this discussion.
Yeah, fine.
And I don't care I hope I'm wrong, to be perfectly honest.
Well, and I think everybody who's listening is going through the same thing. I mean, you're trying to figure, if you got cash and you're trying to figure out, do I get in? Or if you're invested and you're trying to figure out, do I get out? I mean, everybody's got this decision to make. So not just you and me trying to figure it out. Everyone out there is trying to figure it out. But anyhow, and you can look at the poll results. I mean, 41% bear market, 35% correction, and 24% not sure. That's pretty much split.
Yeah, it really is. I think so too. I haven't been watching the poll from before. I'd be curious if anything changed after we talked, but I don't know. Yeah, it is pretty well split. I think, between bear market and correction for sure. It looks really similar to some of the sentiment polls.
Well, I will say this, and I think you and I both can agree on this. The volatility index being as elevated as it is certainly makes things very dicey for everybody.
Yes, absolutely. Whether you're feeling it like it's going to be a rally or just a correction, or if it's bear market, it's something to watch. I like that chart you have. I think that's awesome.
Yep. All right, we ready?
Well, 10 and 10, huh?
Yeah.
All right. I did have a chance to collect some. We had about 28. I'll just show you that RRG really quickly here. Skip back over. All righty. PRQR, not sure what that is, but definitely an outlier. Probably will look at that. I have to look at the chart too. But you can see, as far as the requests go, consumer discretionary seems to be in the lead, as well as healthcare, which doesn't surprise me much. So, but we'll start off with the first one, which is Mohawk, MHK.
All right. Well, first of all, you're downtrending. I mean, here's the chart. Clear downtrend. You can see the gap down there, heavy volume, sideways consolidation to start moving down. Another gap down. Is that an exhaustive gap? I don't know. Maybe. After closing that day, we did rally back up. That's the reaction high. So right now, I'm just looking at this in a range. Here we gap down, and I would, at this point, that was ended up being the reaction high, but it had support previously at about 177, and then once it broke, you can see what happened. I wouldn't take any chances if this stock loses about 114 to the downside. 113, 114, I think that would be a problem for the stock moving down. So it did bounce. We did get as low as 116 and change earlier today. It is bouncing back to the upside. That's the trading range I'd watch.
All righty. Looks like the most popular in the chat room currently is USO.
All right. Well, oil, I mean, obviously has been under a lot of pressure since the beginning of October. So this is a ski slope. I mean, if there's one positive, it looks like, we're starting to turn up, but it's hard to keep a PPO that's at -7 or -7 and change going, because what that's telling you is that you've got about a 7% difference between your two moving averages. I mean, you can just look at the 20 and the 50, and you can see how rapidly the 20 is dropping, where the 50 is much slower. So you're getting this huge gap. Well, the same thing's happening on the PPO when we look at the 12 and 26 day EMAs. So it's hard, at some point it's not a mathematical certainty, obviously, but you do get to a point where sometimes the selling really isn't slowing, but you just can't keep the pace up to the downside. And I think that's what's going on a little bit here with USO. I mean, obviously oil's been under a tremendous amount of pressure. As I annotate this, I think you've got your gap resistance and recent lows. So I think I'm going to say 1050 to about 1130 is a short-term area, and maybe on the top side even go to that declining 20-day moving average, which we haven't even tested yet. But, this is definitely in a downtrend. I can't see any reason to jump in just yet.
All righty. Let's see. Let's make the next one Amazon. Have we looked at that pretty closely today or no?
Nope, haven't looked at Amazon.
All right, let's check it out.
All right. Well, I think it's pretty clear around 1780 to 1800 is a level we want to watch to the upside. And so for me, if I, here we had a lot of selling, big volume coming in. We rallied, and then more and more selling from this area around 1800. You can see the 150-point gap down on very heavy volume, continued selling. Then look at this rally right back up here to about, 1785, maybe 1780, I don't know. Went back down to another low, rallied again. I mean, maybe this is a inverse, head and shoulder pattern. Left shoulder, neckline, head, neckline, coming back down maybe to put in a right shoulder. But that doesn't execute until you get back through 1800. If this is a bear market and you've got this PPO getting back close to the center line, and 2 days ago we were right up there against resistance, if it turns out to be a bear market, that's going to be the best sell point on the chart. Again, I'm not quite there yet. I'm not shorting, but Amazon's got some work to do.
All right. Next one I have for you is from the renewable energy space, Enphase Energy, ENPH.
All right. I was trying to make a breakout, and I wrote about the renewable energy space maybe forming a bottom recently, and some of them have done pretty well here over the past week or two. But this is a pretty interesting area of resistance that we're trying to break out. Yesterday, I don't like that candle from yesterday. I'm not surprised we gapped down off of that candle, but we are holding the rising 20-day. So are we going to continue to hold that? If so, and we can get this breakout above 580 or so today, I like it. Nice volume coming in today. I think overall it looks pretty good. Now, if it goes back down and you have a second tail above 580 and we go back down and close at 550, 560, something like that, I'd have a completely different look at this stock. But right now, if it were to close where it's at today, I'd be bullish.
All right. Let's see. NVIDIA.
All right. NVIDIA, the semis. Wow. I don't like the failures at the 20-day moving average. Clearly, the stock has been under a tremendous amount of pressure. I don't really need to point this out, but there's clearly a very significant downtrend. Now, NVIDIA was $290 a share in October. It just went down under 140, and it's currently 150 and change. I mean, that's when at its low, it was more than a 50%, maybe close to a 60% haircut. These aren't just numbers. I mean, we're talking a lot of billions of dollars of market cap of this company that went out the window in 6 or 7 weeks. Something clearly is changing here. So I am a little skeptical as we come up and we fail at the 20-day moving average. And this is not a chart or not a stock that I would be interested in at this point. I'd need to at least see some basing going on, and then maybe a few weeks, month, couple months, something go back up and break out above this 170, 175 area. But I think we need to consolidate some of this huge selling. A lot of distribution. That volume is not light. There's been a tremendous amount of distribution here. I think it's going to be a while before NVIDIA gets its feet under it. You got another one?
Yes, I do. Walgreens, our only consumer staple, WBA.
All right, WBA still in an uptrend, and I've said before, if I was going to trade this market, it would be more defensive stocks. And I think when you look at a stock like Walgreens, the drug retailers, I wrote about this group recently. I think you have a nice uptrend in play, higher highs, higher lows. It's bouncing off or trying to hold the 20-day moving average. The problem I have with this stock right now is I think that we could maybe make another move back down to test the recent low here and the 50-day moving average. And the reason I say that, and I pointed this out in my blog article the other day, is that you've got a negative divergence here. And so if I annotate this, you can see here the higher highs in price and the lower highs in the PPO. That normally sets up for a 50-period test. So I think you can maybe wait, and you might be able to get a little bit cheaper down closer to 78. So I wouldn't do anything here, especially in the market right now. I don't feel pressured to do anything in this market. I'm just watching for now. But I think Walgreens could make a run back for 78 to maybe reset that PPO.
Sure, consumer staple. Why not? Yep. Activision, Blizzard, the one, it was upgraded, but I did not look at it, so I'll let you do that. ATVI.
Yeah, they're grasping at straws. I mean, yes, a positive divergence is in play, but I wouldn't even trust that. And I'll tell you why. First, let's pull up the positive divergence. Remember, we go from lows down, or closes to closes. That's why I'm not looking down here, because that close was up around 49. Here are your lower closes. Here is your higher PPO. Positive divergence. So you think, oh, maybe we'll run for the 50-day moving average. Well, the problem I have with that theory is this right here. That heavy volume breakdown below that prior low, I can't argue that selling momentum is slowing when I'm breaking down to a new low on very heavy volume. So could we bounce maybe back to 52.50? Yeah, I think 52.50 might be possible in the near term. But to get through that, I'd be shocked. I would steer clear.
All right. Let's see. Next one I have is ANF. And this is Abercrombie. Everybody knows that, right?
Yeah. Nice gap up, heavy volume coming down to test the 20-day moving average. It looks like maybe a change of character off this downtrend. When you gap up, you put in that black candle, that usually is a sign short term you're going to struggle. But so far, holding the 20-day moving average. So again, in this market, I'm going to be a little cautious, but I do like the action so far. I would just keep a stop. If this closed below the 20-day moving average, I would not hold it. I think it would lead to at least a test of the bottom of gap support, which is down below 17 from the 20-day moving average at 1832. That's probably another 7 or 8% to the downside. So I have no interest in holding down to that 20-day. So watch that, down to gap support. So watch that 20-day.
All right. You were talking about investment services. Let's look at CBOE.
All right, CBOE. Yeah, breaking down below what should have held as support. I'm going to stretch this out a little bit longer. Yeah, I mean, here was a breakout. A lot of resistance coming in at about 107.50. So when we finally make the breakout, couple things. No volume to support that breakout, which is troublesome. That's why I like to see volume confirm. We came back down. We did hold it and the 20-day, tried to rally. Again, no volume. And now all of a sudden we've broken this 107.50 level. It looks to me, and you can see the daily PPO going negative again. It looks to me like the overall downtrend, which appeared like it might be trying to change, is resuming again. I don't like this chart. I think to the downside, I think we could go all the way back down to where we were before, which was all the way back down around 91. Maybe we can consolidate in this range for a period of time and then break out, similar to the stock I was talking about earlier. But I think now that we've lost support, this uptrend has lost its mojo. And I don't like the fact that we had that breakout in the first place with no volume. Coming up here multiple times to around 107.50, 108. When you finally get through, you should see buyers coming in, and we just really didn't. nowhere near what we saw on the way down the selling. So I'm going to pass on it. I don't like it.
Okay. Our last one is going to be that outlier, PRQR. And of course, it's a biotech.
All right, huge gap up. I'm sure some kind of an announcement came out, probably one of their drugs are sideways consolidating. I've never heard of the company. That tells me it's probably pretty small. These companies can take off, but they also can get hit hard if anything bad comes out regarding the whatever, if they just have one or two drugs. You got a wide trading range here, 14 up to 22. We're sitting at 18, right in the middle of it. I don't see anything. I would just say this: whenever I've traded these smaller biotechs, just keep in mind you can make a lot of money without investing a lot of money. So I tend to, if I'm going to trade one of these, I tend to trade with way fewer shares, because if they go against you, you don't want it to ruin your portfolio. If this company were all of a sudden come out and announce some kind of a poor drug trial, and it's the only drug or one of two maybe drugs that they have, this is a company could lose 50% of its market cap overnight. I'm not saying that's what's going to happen. I've just seen a lot of these companies, and they can be extremely violent when they make their moves in either direction. So just keep that in mind.
All right, that's our last one. But before you close that chart out, we did get an interesting, I guess it's a comment, not a question. It says, irony is Erin is a bear, but still in the market. Tom is unsure, but is 100% cash. So I'm going to caveat with all I have are my long-term holdings right now. A short-term, intermediate term are gone. So are you holding anything? Do you have long-term or?
I have nothing. I'm 100% cash in every account, and this is not unusual. I mean, when we hit that resistance, I mean, we had a nice little rally, but we had some resistance areas, and we reversed right off of it. We got great news on Monday to open this week, and immediately from almost the open, sellers started. I ended up taking two. I had 4 positions on Monday. I sold 2 of them Monday afternoon, and then Tuesday, when the selling really kicked in, I got stopped out of the other 2. But I have no problems being in cash when the volatility index is in the 20s. No problem whatsoever.
Yeah, just everybody's like, well, he's not really sure it's a bear market yet. He's the one in cash. So I was like, well, like I said, the long-term holdings I still have, but I'm watching very closely to see, if we hold some of these support levels, if we lose that, God, what were we talking about as a support level that we really don't, 2,500, I think.
I would, just add that when anytime you got the volatility index, the VIX, up in the 20s, or worse yet, in the 30s, that's telling you to be ready for some impulsive selling. It doesn't, and you get that whether you're in a correction or a bear market. So the fact that I think that it's probably still a correction doesn't mean that I want to be in. I mean, long-term money, if I was a longer-term person, then yeah, I don't think it's time yet. I don't think the signal has been triggered to get out. But I am not a long-term investor. I'm a short-term investor, and I can't stomach taking these big losses like yesterday or, previous declines. When that volatility index is up and I get stopped out, I sit on my hands. I do nothing.
Right. So you don't typically hold positions more than, a couple months or?
Well, I don't hold through earnings, so I'm not going to hold more than 3 months. In a bull market, when the volatility index is, 9, 10, 11, it's not unusual for me to hold a position for a couple months. But the whole thing is, if I get into a position, I'm looking for 10% and it's up 10% in 2 weeks, then the reward to risk is flipped at that point. So I don't really want to continue holding.
All right.
But anyway.
All right.
Yeah, we could go on and on about that, but I know we need to do a market update and get through that.
Yes, indeed. But I know everybody's curious, so that's great. All right, market update. Let's get started. What has been going on while we have been having so much fun? Well, like you were mentioning, Tom, and I'm going to just make sure I have the most accurate chart up here. All right, so as you can see, like Tom was saying, we are seeing a little bit of a comeback here on the markets, but still down quite a bit. The Dow is down a little over 1.9% currently. S&P 500 down 1.69%. You can see the gap downs that we got, and so far, although the NASDAQ is just about ready to close that gap, it hasn't done that yet, and I don't see any of the other major indexes closing that gap yet either. So that'll be very interesting to see how we get in there. I think if I look at all these charts, the Russell 2000 is probably only one that I would feel somewhat decent about, because that declining tops trend line looks like it's being broken. So that could be good news, at least for small caps. You can see the treasury yields are lower right now, currently at 2.861%. The VIX is flying. It's about 24.63 at our current reading. And UUP dollars down. Gold is up slightly, 117.18 for GLD. USO you just looked at, gap down. Starting back up, looks like it may have hit its intraday low at about 1060. TLT, small gap up, and it's holding that gap support right now, up 0.81% for TLT. And that's all I have for the final market update. Give us time for the Scooter report. Do you have anything to add there?
Yeah, I'll just bring up the S&P real quick and just take a look. First of all, we are trying to rally off that earlier low. I'm not convinced it's going to stick, but we'll see. I mean, this was a key area, so it wouldn't be shocking. Remember, 2582 is the number from back in February. We've never closed, well, in 2018, we have not closed below 2582. So we were getting close at today's low at 2621. We were only about 1.5% away. And we know how fast 1.5% can evaporate based on what we've been seeing in the market. The other thing I would say, here's the hourly chart going back the last 3 months. And I think clearly off of this downtrend, the reaction highs coming in at about 28.15, 28.20. It's kind of that short to intermediate, well, I would just say short-term resistance to the downside. This 26.25, 26.30 area has been holding for the most part with just a couple of tails below that level. So it's possible we certainly could continue a short-term rally here tomorrow morning. We got non-farm payrolls. I'm telling you, that thing, we could be anywhere in the morning, which is why I don't want to flip a coin with my portfolio. So I'm just going to sit back and watch it. But keep an eye on the 20-hour moving average, which has now come back down, because after breaking below it and volume increasing, that first test of that is going to be pretty important. And we have seen in the past how when we've had these impulsive moves to the downside, how difficult it has been on many occasions to get back through that 20-hour. We've seen it probably 3 different stretches over the last 2 months. So I would watch that. I think getting back up through 2,700 is going to be very, very difficult in the near term. And I think it's probably going to set us up for a 2582 test.
All right. Let's get started, I guess, on the Scooter report.
Go right ahead.
All righty. I'll grab this and show you what I'm just going to do it similarly to the way I've done it in the past. We'll just use the tiles on the home page, and I'm looking at the technical rankings tile. Okay, get it here. So you can choose scooters, but you can also have, my DP signal tables. You can also have obviously the ticker cloud top 10, but we're going to look at the scooters, and you can see we have tabs here, top 10. So the best these scooters, StockCharts Technical Rank. Should at least tell everybody what that is, since not everybody's heard of it. So yes, the scooters. So we're looking for the high ones. They tell you that they are already strong. They have relative strength. They have internal strength. And so that's one to look at. And I'll show you the top up as well. And you can see how we're getting all of these specific changes here. Let me go ahead and make this bigger. All right. Okay, so what I'm going to show you is that what I like to do, because I have my own decision point candle glance set up, is I like to take these, and I'll do this not only with the scooters, I'll do it with the top 10 as well. You go down here and you hit candle glance. And now all of those charts are in candle glance the way I like to look at them. So these are the top ones. So I can look at this and say, okay, this one, for example, CHD, Church and Dwight, we have everything's moving up a little bit or moving sideways, and yet we have a PMO that's on a sell signal and heading lower. So despite having a decent scooter, I would certainly stay away from that. But are there any that maybe are enticing because of the way they're set up, and I know that they have such a good scooter ranking? I would say the closest would probably be Thomson Reuters TRI. It is on the buy signal. It's really late for me if I were to get in. So that would be something to consider. I think that honestly, if you were looking for a shorting opportunity, I'm looking at TripAdvisor here, TRIP. And you can see it's got this gap here. We did close it, but it headed back up, and now it's starting to turn back over. And you could really make a case, I think, for a double top here coming off that gap. I would expect to see this moving lower, and you can see in overbought territory, we're just about ready to get that sell signal, which is the opposite of how I trade for buys. So that's perfect. It's just about ready to get that sell signal on the PMO. So that makes me happy at this point. So maybe you could consider TripAdvisor as a possible short down to that 57.50 level. So that would be one I looked at. Let's go look at the top 10 though. Or not the top up. Let's look at the ones that are making the big moves. That's where you usually are going to find your opportunity. All right. So these are the biggest movers. I'm looking at these, and I can see a lot of problems with a lot of these. So despite good moves on their scooter, when you see tops below zero lines, when you see the 50 getting ready to cross below the 200-day EMA for take two, TWO, you can look at these and know already just right off the bat whether you even want to look at the chart. For these, I guess the only ones I'd be interested in, I might be interested in SHPG, Shire, because it did go below the zero line, but it's getting ready to turn back up. The scooter is still above 75. Now that I look at the chart, well, we managed to get above this declining tops trend line, so maybe not as good a look on the big picture chart as it looked like on the candle glance chart. So it's very interesting. So like that one I would not include just because it's obviously a low volume trader. It's, doesn't get very much movement during the day. Luxottica, that's consumer discretionary. So I likely would be staying away from this, but it certainly looks interesting. LUXTY, getting ready to get a PMO buy signal. There's that nice scooter move to the upside. The only thing I would probably be worried right now when I look at it and in the thumbnail is a possible island reversal here. That would be, something to pay attention to. 50 is below the 200. This is why when things are looking like they are in a bear market, I'm short term, I'm out, because there's so few opportunities. And these are the ones that are the big movers on the day. They're seeing internal strength, improvement, that sort of thing. But the charts just aren't looking very good. So pass it to you, Tom. What you got?
All right. I'm going to just take a look, and I'm going from that member dashboard as well. And when you take a look at this, you can set these up. I kind of go back and forth, but I do like to look at the scooters and then break them down by the various cap sizes. If you're not familiar with the scooters, essentially what you're doing is you're ranking all of the large cap stocks from 0 to 100 based on some predefined formulas. A lot of it is based on the longer term picture and the longer term rate of change. And so, you can go into chart school and take a look at the formula if you want. But one of the things that, you can do is here I'm looking at the top down on the large cap. So these are the stocks that have taken the biggest hits to their scooter rank today. Now, I'm looking at this one is 75 and this one's 79, ROL, and CNC. So these two before today would have had scooters up in the 90s. So clearly these are falling quite a bit from, kind of lofty level. So that would be kind of interesting for me to take a look at and see what happened. And I looked at both these charts, and I thought they were both somewhat telling. So let's pull up ROL first. Notice yesterday, you see this resistance area over here, and this is what we talk about whenever I talk about a short-term sell signal. Here we had a breakdown intraday back on Tuesday. And look at this finish on Tuesday. Very, very strong period of selling. Now, of course, the market was weak. But when you fail at resistance, I don't care what the overall market's doing. If you fail at resistance, that generally is a sign you're going to see some additional weakness. Here you can see ROL down another 7.5% today. and it is completely breaking down. It looks to me like maybe it's going to run back down to test this double bottom near $55. Off of an uptrend, this now just simply looks like sideways consolidation to me. Maybe equal highs, maybe we'll end up putting in a higher low and we'll get an ascending triangle. Really hard to say exactly what's going to happen. But my point here is when you get a false breakout and you reverse like this back to the downside, you want to pay attention, especially as a short-term trader, because I've seen more often than not follow up just like we're seeing on this chart today. The other one I wanted to point out was CNC. And you're going to see something very similar. Actually, it's even, I think, more egregious. I mean, when you look at this chart, look at how many times we have tried to get through 147 and 147 and a half. We opened right around that level. Yesterday traded up to about 149 or 149 and change. And look at that reversing candle. That's a bearish engulfing candle after a false breakout off of this uptrend. And look at what the stock has done today, down another 5.9%. These reversing candles, especially as a short-term trader, I think you've got to pay attention to them. And, you know, a lot of folks say, you know, when do you sell? You know I always feel pretty comfortable buying. I never know when to sell. Well, for me, these short-term candlestick signals are incredibly accurate at times. And again, it's about managing your risk more than it's about always being right. You get yourself near a resistance level, you see a reversing candle. I don't want to take any chances. I don't want to be in on a candle like this. Maybe it keeps going higher, and that's great. If I made money on it on the way up, I'm happy. I don't want to be, you know, watching it lose all of my profits. So those were the only two I had today. Here is your summary for our quick scooter report today. Definitely check that out, though, in Chart School. If you're not familiar with the scooter report, it is a quick and easy way to evaluate a stock versus all of its peers, developed by John Murphy. So you know right there it's going to be a pretty solid technical tool to have in your arsenal. And it is an exclusive here at StockCharts. You're not going to find this anywhere else.
All right. Yeah, I do use it periodically, but wow, can you tell the difference when you looked at the top down versus the one I looked at the top up? I mean, there really weren't very good charts on either of those. But, you know, those top downs, yeah, those are some great short opportunities.
Yeah, well, I don't know. I mean, the two I looked at were kind of in uptrends. I wouldn't have shorted, but I would have gotten out. I would have sold and, you know, at least.
Okay.
I would have at least taken my profits and moved out of it. But just to give everybody a quick update on what we're seeing right now, you got the Dow Jones Industrial currently down 485 points, NASDAQ down 71, S&P down about 48, back at 2652. Russell 2000 very close to the support that we've been watching across all of 2018, near that 1450, 1445, 1450 area. We were below 1450 earlier on the Russell, as you can see right here. So let's see what happens in the close. This could set up for a big sell-off today, Erin.
Yeah, it's looking like it at this point. So yeah, like I said, I hope I'm wrong. I hope this is just a correction, and when we get down there and test that area of support on that S&P chart, hopefully it'll turn back up. I don't have a lot of faith that it will, and if I don't have faith that it will, I can't be in intermediate or short term. Like I said, I'm holding long because the very long ones, because we could be looking at a correction. But if I start to see the breakdown below that 2,500 level, they're going to be gone.
We have to watch that. All right. I want to thank everybody for being with us today. Please remember to complete that survey as you exit. We would love to get your feedback, hear what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. Big jobs report tomorrow. See you back here tomorrow. Happy trading.